Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, May 27th, 5:23 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the below average edition of the Big Show. I say below average because MarketSmith's entire infrastructure appears to be down, so I'm having to use backup Yahoo charts. So this will not be as crisp, clean, and refreshing as it normally is. But bear with me, we'll get our point across as to what's going on with the market. So let's get into it as best we can. State of the market changed from correction to short-term uptrend because on Thursday, 5/26, we had a day 5 follow-through day, and actually today, 5/27, an additional day 6 follow-through day on the NASDAQ. That got our market leaders from downtrend to neutral, and short-term moving average signal from downtrend to neutral as all indexes have at least two closes above the 21. The NASDAQ has one. We get that second close above, we'll go to bullish. Certainly some improvement as far as leadership is concerned. That's why we've come off bearish and downtrend to neutral there. As far as our medium-term and long-term indicators go, still in a downtrend as we're beneath the 50-day moving average across all 5 major indexes and below the 200-day moving average across all 5 indexes. So what happened today? It's really a summary of what happened for the last 3 days. Tuesday when I did the video, I said the market index is bent but didn't break. We had a gap down, an ugly gap down at the open on Tuesday, but we finished a lot better than it could have been and put in a hammer candle in on the indexes and in a lot of leading stocks. Then Wednesday, after the Fed minutes came out, we had a big push to the upside. Didn't get too excited about that yet because the last 2 times the Fed was involved, Powell specifically, which was on the last Fed meeting, and then a week afterwards he spoke. The market indexes rallied after his remarks and then dumped bad the next day. This time on Thursday, they did not dump. In fact, we had a follow-through day with some strength, and now on Friday, a second follow-through day. This gets us off of our bearish posture from a short-term perspective. We bought a couple of stocks, got rid of our short-term hedge, and we're now re-engaged with the market looking for follow-through strength. So 3 straight 80% up days. That's a stat that's very infrequent, and it certainly indicates that there's a change in bias with what's going on with the market. So covering the indexes, our G6 growth index up 3.6%. This has been verified that all 6 components are now above the 21, and that's a signal that we're looking for also to accompany some leadership in stocks. S&P 500 up 2.5%, NASDAQ 100 up 3.3%, Dow up 1.8%, midcaps up 2.3%, Russell up 2.7%, 60/40 global diversified stock and bond index up 1.3%, GROTECTION bringing up the rear, just barely positive on the day and flat over the last 2 days. I'm going to get into why that is, and I'm going to bring up a chart. This is a very common occurrence of how the expectation for how GROTECTION should perform versus various market conditions. I refer to this chart often because we're not pie chart. We don't stick with doing what the market's doing. Very often we're zigging when the market is zagging, and vice versa. And certainly when markets are bearish and we need to get out of the way, it's going to take a while to go from getting back out of the way to getting back involved with the market. So you can see here the expectation during correction or a bear market into the early recovery phase is that we'll have moderate underperformance. We saw this in March. The first couple of days we were up fractionally while the indexes came off the bottom up 5.7%. Same thing the last 3 days, barely positive while the market was up 5.5%. But you can see the green arrow where we are now, but where were we was during a bear market. Our expectation during a bear market is we're going to have major outperformance, which we in fact did. This is why we're okay with lagging coming off the bottom. We want the market to improve itself, because year to date through May 20th, we were only down 6.3%, while the S&P was down 18.2%, and small caps and the NASDAQ down 20 and 28% respectively. So just if this laggardship, so to speak, is just a function of the type of market that we're in right now. We're transitioning from a correction / bear into the early recovery phase. And if stocks continue to act well, we'll increase our exposure and participate in the uptrend. So this chart, I refer to it often because under various market conditions, I want to make sure our expectations are in line with what we should be doing. And if not, then I'm not fully engaged in what the market is actually telling me. So let's get into the ugly Yahoo charts. But first, let's get into the team here at Revere. We just did a fantastic podcast. It'll be available on Saturday. Trend following is what we do. As we transition back to an uptrend, we re-engage with the market. In a strong bull market, we're fully engaged. In a consolidating market, we pull back a little bit. In a downtrend, we get the heck out of the way. It served us and our clients very well. And if you're interested in this approach, email any of us, Dan, Tim, Hunter, Muriel, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. So let's get to the tail of the tape and these Yahoo charts. So tail of the tape. We've transitioned. You can see the green arrow here from bear case to bull case with this 526 follow through day, and the confirmed uptrend follow through on 527. So we're off of our bear case now. Rally's been initiated. We reclaimed the 21. We've seen some leadership. So we're operating under the bull case scenario, certainly as far as short-term indicators are concerned. So some news this morning that seemed to spark the market. Some inflation data came out. April core PCE inflation was in line with expectations, which was a 0.3% for April, and year over year 4.9%. Those were both as expected, so not worse than expected. The market seemed to like that, seems to indicate that perhaps inflation is peaking or has peaked, and we rallied into the open off of that, opening up 0.65%. What we were watching coming into today was we broke through this 40.50 level yesterday and wanted to see if we pulled back to it, would it hold? The lowest we got today was 40.77. We opened at 40.84. Didn't really even test it, so showing some strength there. Then the next resistance level, 40.90 to 4100, we broke through that shortly after the open and continued higher. So certainly some confirmed strength for what we want to see as far as good action in the market and some leadership coming to the fore also. So some notes: TNX continues to bounce the 50-day. This is something, so what could go wrong? Interest rates have pulled back to the 50-day, a strong bounce off of there, along with, we talked about this in the podcast, Tim talked about it in his Wednesday video, the dollar has also pulled back to the 50-day. If both or either of those show significant strength, wouldn't be surprised if that reared its head as a headwind again in the market, and maybe we just put in a little bit of a handle at this point after 5 straight strong days off the bottom. That's really what you want to see. You don't want to see straight up action, because for the most part, straight up action is just short covering, not necessarily action that can be sustained. So that's something that we're keeping an eye on. Let's see what else. So sectors, 11 out of 11 sectors strong today. Yesterday was 10 out of 11. Yesterday only XLRE was red. Oils started out bad on the day, finished with a bang. So it's not like money is coming out of oils and going into other sectors. Semiconductors and software were particularly strong today. And as far as negative goes, all I could say is that these are negative from a relative strength standpoint, as there was mixed results within the leadership, but fertilizers, coal, shippers, and gold and silver stocks lagged from a relative strength perspective today. So what do we do in the portfolios? We got off our short right after the close when we saw follow through strength above 4,100. And then we added to two of the buys that we did yesterday, LNTH and ZIM. These two were taken from the 21 over 21 leaders list, presented good entry points. We started with 2% position, added another 2% to them today. So we're up to 4% on them. We've also still got our VTIP, which is a short-term inflation protected bonds. We own 5% gold and 4% TBT, which is a play on rebounding interest rates. So if interest rates rebound and drag on stocks, TBT should absorb some of that until we can determine if this rally is going to continue or if it's going to pause for a while or reverse. We're coming up into a big resistance area, this 4160 to 4200 area. So need to see how we act relative to that area. But the bottom line, things have changed. Definite change in character the last 2 days, short-term uptrend with actually 2 follow-through days. And we go from there, see what next week brings. A couple of key levels that I want to mention is, and you can see how we're recovering these one by one in the market. We held this big level down around right above 3,800 late last week and early this week, bounced off of that, and have reclaimed a couple of key areas since then, including what is now a rising 21-day exponential moving average. Big plus for the indexes. So we closed basically right on that yesterday, and above it significantly today. So good stuff there as far as participation goes there. And then again, I mentioned today we got through the 4050 to 4070 level, strong break above, closed at 4158, which is right below this 4160 to 4200 level. It'd be very more clear to show it on my MarketSmith charts, but for now, you're just going to have to take my word for it. But you can see here on the SPY, above the 80 above the 21, that's the green line. We got the red line here, the 50-day moving average, which is the next target that we need to overcome, and that is still above this 4,200 level. So big areas of resistance overhead. That's why we're not plunging 50% into the market at this time. And then all the way up quite a bit above, you've got the 200-day moving average. Let's look at the NASDAQ 100. You can see first close above the 21. There's still a lot of work to get up to the 50 and the 200-day moving average. Let's look at the Dow Jones Industrial Average. Here's the diamonds, 2 closes above the 21, coming up to approach the 50. Mid caps, MDY, we noted some relative strength, but these started last week as they didn't undercut the lows from 2 weeks ago. 2 closes above the 21, and IWM, also 2 closes above the 21. So as far as on a short-term basis, our short-term indicator, our moving average that had acted as resistance prior, anytime we were trying to rally off the lows, this time it was conquered, and now we face the next big level, and that's the 50-day moving average. So 21 over 21, I had 6 that I wanted to get in, 3 that I clearly wanted to get out. So I'm actually going to review 24 stocks here and then call it over the weekend. But let's talk about 3 that were punted out. We had 3 shippers in last week, and these charts still look okay, but they're really not liquid enough for us to get into, except for a very small position. ZIM is, and that's one of the ones that we bought, so it's good to see other stocks in the group acting well. That's always something you want to look for. But we punted out SBLK and GOGL. Also good charts, and as I mentioned, we bought ZIM, and the other one that we punted out was Dow. Lagging from a relative strength standpoint, this still looks like a very fine chart, but there's some chemical companies that are up closer to all-time highs. And in a bull market, you wouldn't expect Dow Chemical to outperform. So as I started this Fab 40 a couple of weeks ago, saying that there were some in there that were holding up, but some that I would never buy. This is one of them. That's not something that would be on my purchase list. So now we're going to go through the remaining 18 stocks that were from the 21 over 21 list from last week, and then I'll talk about the 6 new ones that I want to go through. Start with AMCR, Amcor, still looking good. Now what you're going to see is these are survivors from the last 4 weeks, and they're all obviously above their 21, so still continuing to show relative strength as the week went on. Which means that money wasn't rotating out of them. Here's AMR, coal stock, near all-time highs. Arch, another coal stock, pulled back today, and it has been very choppy, so AMR actually acting better. But you can see anytime it tries to get below the 21, it bounces, and very choppy though, but still holding up. CC, chemical stock, near or at all-time highs. Oil, Chevron continues to act very well. Devon, another oil stock, continues to look great at all-time highs. Eli Lilly, medical stock, all-time highs with a breakout here. So, and this is considered kind of a defensive stock, so it's not like some things that held up are all getting thrown to the wayside and all the money is flowing into beaten down tech. That's not the case, and that's actually good for the market. LNTH, this is the other stock that we bought today. It's a medical stock. Bought it yesterday, added to it today at all-time highs. LTHM, this is one I wish I would have bought. You can see the move on that today as it broke above the 30 area. And one of the other 6 stocks that I'm going to add is a sister stock to this. Where is that? Yes, ALB. Okay, we'll show that later. Okay, LTHM, MCK, McKesson, not real strong this week, but didn't give it up, so that's good. MRK, Merck, another drug stock, continues to hold up well. Pulled back yesterday, inside day today. I would expect Merck not to continue to outperform if this transitions into a strong bull market. OLN, chemical company, all-time highs, bounced very nicely off the 21 3 days ago. ON, the semiconductor stock that is among my favorites, clearing resistance above this big 60 level. This was the 3rd stock I was considering buying yesterday, but did not. I went with LNTH and Zim, but this is very much at the top of the list if tech continues to act well and if semiconductors continue to act well. Oxy, another oil stock that continues to rock at all-time highs. AT&T, again, wouldn't expect it to outperform, but as of right now, it was down today. Not a surprise, really, but still showing some relative strength for the week. WCDC, Western Digital, a storage stock. WDC, a storage stock, putting a nice base in here. Nice bounce off the 21. ExxonMobil, XOM, all-time highs, and the other stock that we bought, ZIM, ZIM, the shipping stock. It's a little bit of a misleading chart here. They declared a 4% dividend yesterday. So MarketSmith subtracts that. Any change over 4%, they modify the chart. And the chart on ZIM, because they pay big distributions all the time, they adjust the chart in MarketSmith. They don't adjust it on Yahoo, so this chart actually looks a lot better, and it actually cleared this resistance if you add the 4% onto the price action of today. So those are 18 of the 21. Now let's show the other 6. Ulta paid the price last week when all retail stocks were thrown in with Target and Walmart as they missed horribly. But a lot of retailers have reported great results over the last 2 days. Yesterday was Williams-Sonoma and Macy's. Today is Ulta. gapped up near all-time highs near the top of the base. Definitely want to keep an eye on how well-performing retail continues to hold up in this market. Albemarle is the other chemical lithium stock. They do more than lithium, but you can see it break above 250 yesterday and continued higher today. This was high on the list yesterday, but we only wanted to buy two. T-Mobile continues to form a very nice cup base near the top of it. So maybe money's going to continue to flow into these mobile stocks. I don't see anybody getting rid of their cell phones anyway. DAL, airline stocks have been very good over the last 3 days. DAL is the leader among the airlines. We wanted to get a bank in here. The best looking bank is MTB. Most bank charts look like death warmed over, but not this one. And this is actually, there are a couple very small bank charts that look good, but this one is liquid enough for us to get into if we wanted to buy a bank. MTB looking pretty good. And finally, the sixth one, this one's going to surprise you and you're going to ask me why, but Zoom, after reporting earnings, has now had 4 straight up days. Cleared its 21, cleared its 50-day moving average. I know it's well below its 200-day moving average, and you know I'm known for saying nothing good happens under the 200-day. And if this were a couple of percent below the 200-day, I might pay more attention to it. But a lot of this damage had been done in the past. Really, the area that I'm looking for it to get up through is this recent area. And if I had the Market Smith charts, I could show you that from a fundamental perspective, this is now very, very reasonably priced on a PE basis relative to its earnings, and it is a solid moneymaker. It's not one of these stocks that continues to just bleed because they don't have a sound business strategy. This is one that I want to keep my eye on. I want to keep it on here because I ran through a bunch of the laggard software stocks, and this is one that since April 1st, when things kind of started coming off of the bottom, this is the number one performer of the ones that I charted. Granted, I didn't chart every one, but I charted about 25 of them, and this is the best acting one. Some of them had earnings results that they popped and then gave it up immediately, but this one didn't. I've talked enough about Zoom now, but just wanted to explain why I have this on the list when normally I wouldn't. And that is going to wrap it. As always, love to hear feedback from you. Sorry about not having the Market Smith charts, but actually these Yahoo charts weren't so bad. Love to hear your feedback. Email me, don@revereasset.com. Phone is 855-REAL-WELL. So next week, let's go back to the tail of the tape quickly. And the area that we want to look for on the upside, this 4160 to 42 area is a pretty significant resistance area. If we go up and sideways and chop for a couple of days, reminder, we're closed on Monday for Memorial Day. I wouldn't be surprised at all, but that will give us an opportunity to separate the wheat from the chaff. Maybe some stocks that just got a knee-jerk bounce and people are taking profits on them. Now we want to see which are the tennis balls and which are the eggs, which ones, if they correct, come right back up, which ones, if they start to correct, continue to go down and go splat. So on the upside, this 4160 to 4200 level. On the downside, we want to hold this 4050 to 4070 support level that we broke through in a very strong manner today. So those are the two levels for next week that we'll be focused on. And that's going to wrap it. So closing up the week ending May 27th, we have one trading day left. That's next Tuesday in the month. Big comeback over the last 3 days in the market. Certainly change in character and change to a short-term uptrend. How far it goes will be determined, but as always, we'll have our fingers on the pulse of what's going on. So please continue to join us here in our video. So wrapping up the week ending 5/27, this is Don Vandenbord telling it like it is. Thanks for listening and have a great weekend.